We're back again with another basic financial planning video. We talked about traditional investments in the last one, and I'll put a card there and a link in the description for it. Now we're going to talk about the other part about it, because I think it's important for Canadians to understand the types of income that your investments will generate. So there's 3 different types, and we're going to get into them today on how they work and maybe where you can avoid them or how best to utilize them if possible. And let's get right into it. My name's Aaron. This is Cozy Financial Planning. Let's get into it. What do we have today is we're going to talk about the interest income or the income off your investments and how they all work. I will give a couple different tips after each one for your investment purposes and maybe where to place them if possible and how to kind of avoid things a little bit. Okay, so there's 3 major ones here in Canada. We have interest income, we have capital gains, and we have dividends. 2 of 3 are very advantageous for you, 1 not so much. We're going to get to that one first, which is interest income. Interest income is strictly taxed at your marginal tax rate. I've discussed that before in a previous video, but if you're not sure what it is, it just means that where your income tax, your average income tax is every year, like where you're ranked in the bracket system here in Canada, you're going to be taxed at that based on the interest. If you bought a GIC or a bond and generated $1,000 worth of interest, and you're in a 30% marginal tax rate, you're going to be taxed $300. That's just the bottom line. This also includes T-bills, savings accounts, which is very important for people to know, is that they are fully taxable. Even if it's a low interest rate of 0.001 or whatever it might be, if you generate interest off of it, you have to pay taxes on it every year. So savings accounts are not necessarily the most advantageous. Anyway, since it's such a highly taxed system, if you have these investments, it means you want to protect that. You would want to put it into something like a tax-free savings account or even an RRSP, so that way they're not taxed necessarily. You got tax deferral, or in the tax-free savings account they're completely tax-free when you take the money out, and that type of thing. You just want to be mindful of it. It doesn't mean that's always the best situation for everyone, but it gives you an idea of what to potentially use it with. So the second one is capital gains. Now, the government of Canada gives us an advantageous position of this, the CRA does, in the sense that only 50% of your gain is taxable. So if you invested $1,000 and it grew to $2,000 and you sold it, you only have to be taxable on $500. So you have the growth of $1,000, 50% is taxable. That means only $500 is taxable. So what that means is if you're in a 20% or a 40% tax bracket, only $200 of tax. So that means you're going to gain $800 compared to the 40%. If you only gained $1,000 in interest, you would have had to pay $400. It would have been double. So capital gains, it's just an incentive for the CRA to encourage investing in general. The ones that generally cover this are capital, like stocks and mutual funds generally have a lot of this, or stocks in general actually have capital gains. You also do this with investment properties if you aren't claiming them as primary residences. In addition to that, we have dividends. Now, dividends have a tax credit for Canadians, and that is because the government has already taxed the corporation on the money, and then they get paid out to you, and so it's to avoid double taxation. So there's a small calculation for it on how to do it, but essentially you just have to know dividends are taxed less than interest. So again, you want capital gains and dividends. Dividend payouts are stocks and mutual funds. Those are the 2 major ones that do it. You will pay less tax on them. You can use these in non-registered investment accounts. They don't have to be in tax-free savings accounts, RSP, if they're maxed out. These are good for that because your taxes are going to be less. I'm not saying not to use TFSAs and RSPs for these because you get tax deferrals on, tax-free savings accounts are tax-free. But RSPs, for example, are tax deferred all the way till the end. So you get all that growth on not paying the taxes, and you'll get a lot further than you would. And just as a disclaimer, I'm not an accountant by any means. I'm just giving the facts on how these things are taxed and how I would help position with clients. Potentially, if I was point blank told which ones to put in which accounts, these are kind of what I would do for someone. But it's very, very specific to you and your needs and your situation on which ones to do. Anyway, I'm hoping that was clear, pretty straightforward. Interest is the worst one, but it's the safest income to receive. Capital gains and dividends are better because they're tax preferenced in some manner from the CRA, and you want to utilize them whenever you can. You will get higher growth off those investments like stocks and mutual funds as well. And I hope that kind of sums up a lot of this stuff for you and makes it a little clearer.